Hello, my name is Mark Shields. I'm one of the investment managers on the multi-asset team here at Brooks Macdonald, and we have responsibility for managing the Brunsdon portfolios, both the Brunsdon Adventurous and the Brunsdon Cautious funds. And I'm just going to give you a quick update regarding the funds over the past quarter and as to where we see things heading from here. So on the whole, over the quarter, it's been a positive period for both the aggressive fund and the cautious fund, with both the funds ahead of their respective benchmarks. This has largely been driven by risk assets, so equities which have continued to do well, having had a decent first quarter in 2019. So for both funds, the risk assets within the portfolio have been the strong alpha generators. We've also seen some decent returns from the bonds or the fixed interest element to Brunsdon Cautious as well, and that's quite a rare event where both fixed income and equity deliver correlated positive returns. Typically you'd find that they would move in an uncorrelated fashion. So that's been fairly positive for the overall performance of the portfolios. Our base case within or view remains that equity markets should continue to deliver, but we remain very much cognizant of the fact that we are probably closer to the end of the market cycle than the beginning, and that has made us make a few changes within the portfolios over the past quarter. So within Brunsdon Adventurous, we've decided to slightly reduce the overall risk of the portfolio by reducing our exposure to UK smaller companies in favour of topping up our large cap exposure. We have maintained an overweight to UK smaller companies for quite some time, but now that we're in a position where actually we think there is a risk from Brexit, a risk of an early general election, and also a liquidity risk, all of those three factors combined have made us a little bit more nervous regarding that UK smaller companies positioning, and as such we've trimmed to move the proceeds into UK larger companies. We've also trimmed our exposure to European mid and small caps. Again, this asset class has had a very strong 2019, and it seems prudent to us to take some profits from that position and to, whilst we've maintained the overall equity exposure, just to move that into slightly more defensive position within the portfolio as a whole. Similarly, within Brunsdon Cautious, we've chosen to move a position we had in Neuberger Berman Uncorrelated, which is a fund of absolute return funds. We've decided to sell that position because it didn't perform in Q4 2018 quite as well as we would have expected it to. It has had a slightly better run of performance recently. This has presented us with a bit of an opportunity to come out of that fund and to move the proceeds into some convertibles. So we bought two funds. One is a global convertible fund, one is an Asian convertible fund. Nominally they're slightly higher risk than the Neuberger Berman, but actually what these funds can provide us with is the potential to enjoy some equity-like returns, or at least a partial participation in equity market movements with the protection of a fixed income like position. So they're giving us almost the best of both worlds, we hope, and we feel that at this point in time they're a reasonably appropriate position to hold within the portfolios. Within Brunsdon Cautious, we did slightly reduce our overall equity allocation or exposure, by selling the remaining position in Artemis Global Income. This is a fund that we reduced down at the beginning of the year. It has rallied fairly significantly following a pretty torrid Q4 2018, but we feel that now's probably the time to come out and just to take a little bit of equity risk off the table for Brunsdon Cautious. In terms of our outlook, we think that the global investment market remains reasonably positive for equities as we are at the moment. Although, as I said earlier on, we do remain aware of the fact that we are towards the end of the cycle rather than the beginning, and we do think that there is a risk here of further equity market volatility spiking up at some point in the future, which may well be very difficult to predict, especially if it's politically driven or similar. I hope that's been of use. As ever, if you have any questions or queries, then please do get in touch with myself or another member of the team, and we'd be happy to answer any questions that you may have.